Welcome everyone to the Arnott Opportunities Strategy 2020 half-yearly webinar. I'm Kenny Arnott. I'm joined by Yianni We're the joint CEOs of the Arnott Opportunities Strategy. Thanks for joining us today. A couple of important disclaimers that what we provide today is for general financial product advice only, and that our past performance is not necessarily indicative of our future performance. Bit of housekeeping. We run one strategy across two funds on a pari passu basis. For simplicity and consistency, all performance reference in this presentation will be the Arnott Opportunities Cayman Fund. So I just want to begin with a brief review of our investment approach. What's asymmetric investing to us? We're an absolute return manager. We focus on thematic investment opportunities with an equity bias on a global basis. And our aim is to produce above average returns with below average drawdowns. We do this by finding good investments and not losing money along the way of realising those good investments. Our asymmetric approach has four pillars. First of all, find asymmetric themes. Second, invest in the best ideas within those themes. Third, focus on macro drivers for risk and opportunities. And I just want to touch on this one briefly. Being a global thematic investor, we spend most of our waking hours scouring the world looking for interesting early stage themes. And as part of that exploration, it's almost impossible for us not to come across, be influenced, and end up having a view on macro goings on around the world. So we don't run our process by looking at specific bottom-up ideas and then thinking about macro as an adjacent. Thinking about macro is absolutely embedded in our whole process and ultimately forms part of our asymmetric aim, producing reasonable returns with low drawdowns. Then fourthly, to generate an asymmetric return profile. So what's a global thematic investor with an asymmetric investment approach doing in Sydney, Australia? Where did our asymmetric approach come from? There were two important points. The introduction to asymmetric investing came when I went to work for Paul Tudor Jones' uncle, Billy Donovan, in Memphis, Tennessee, trading cotton. He introduced me to the concept of asymmetric investing. I then went on to work for Macquarie in both the commodity and equity divisions as a derivative trader. And it was there that my risk management skills with regard to asymmetric investing were honed. And together, these two experiences form the foundation for the strategy. In '99, I founded Arnott Capital and the Arnott Opportunities Strategy. And we've delivered asymmetric returns ever since. We're not going to go into our investment process or workflow in detail, but I just want to run through this summary slide because we're going to make reference to it as we talk about some of our investment ideas later in the presentation. We've got a four-stage discipline process about how we go about our investing and portfolio management process. Undoubtedly, the most important part of what we do is to find ideas, identify themes. And what we're looking for is early stage thematic opportunities that are not yet priced by the market. The second part of what we do is identify the best way to express the theme, do valuation work to determine the best stock or other instrument within that theme. Third part of what we do is determine market factors for entry and exit. And in this sense, nothing gets into the portfolio unless it meets trading asymmetry. We tend to separate what metrics we look at from an investment point of view, from our trading or tactical point of view. Now, the fourth thing we do is we put those different themes together into the portfolio. We curate the portfolio. This is undoubtedly one of our core competitive advantages, and it is a real driver of how we deliver our asymmetric returns. What we're trying to do is construct a portfolio knowing that we don't actually know where markets are going. We're certainly always trying to figure out what is the base case. We're always thinking about the tails, tails have low probability occurring but high impact. And what we look for, particularly as we look for tail situations which may be mispriced, because they can cause a lot of grief in portfolio management. And ultimately what we're trying to do is to put together a group of idiosyncratic opportunities and risks which aren't all correlated to the same underlying situations, events, linkages, commodities, whatever it is, so that when we get that theme wrong, which we will, that we don't damage the performance of the whole portfolio. And it's a crucial part of what we do. And given that markets generally perform in what we would call a normal way, let's call that down 10%, up 15%, managing the portfolio for what happens the bulk of the time is where we spend the bulk of our waking hours. So number 4, curate portfolio to survive a range of market outcomes by putting together uncorrelated themes, considering linkages and risks of all those themes. Just want to now run over performance summary, looking at the last 12 months and over a longer period. We delivered 18.22 positive for the last 12 months, and that takes our annual return to 23.58 since 13. Pleasingly, we did that over a 12-month period when it was pretty tricky, to say the least, and when risk assets really found pretty tough going. Over the same period that we delivered that 18%, global equity markets measured by the global MSCI returned negative 15.61%. A core part of what we do in asymmetric investing is limiting our drawdowns. On the right-hand side, we've just put together some recent drawdowns on a quarterly basis, measuring the MSCI when it has a quarterly drawdown greater than 10%. There's 3 instances going back to December 18, minus 13.74, minus 21.44, minus 16.6. During all those instances, the Arnott strategy had virtually no drawdown, meeting our objective of producing reasonable returns with low drawdowns. Our broader objective is to deliver annual positive returns over the long term, importantly, and really importantly, irrespective of what any financial market performance does, any other financial market does. So it's worth just taking a look in the table below. You can see we've delivered on this. We've delivered in producing reasonable returns, and we have done that over many timeframes, and importantly over the last, or the more recent time frame when it's been a pretty troubled time for markets, we've still delivered that. Just looking at our longer term average metrics, just want to draw your attention to what is the second part of our portfolio management that's really, really important. Mentioned that when we talk about putting the portfolio together, we really plan for a normal market environment, maybe down a little bit or up a little to a lot. Obviously, the other scenario, the type of markets that you can have are really nasty markets that can be down a lot. Now, we don't have any better predictive power than anyone else about picking those markets, but because we focus very much, as I mentioned, on tail risks, low probability, high impact, and particularly tail risks, which may be a little bit higher probability than the market's pricing, we're very, very conscious of looking for signals that markets might be in trouble. It doesn't mean we're natural bears, it just means we're on the lookout for trouble. Now, when we get into those type of markets, then we modify the portfolio to survive those markets. And as evidence that we've been able to do that, you can see here this metric, average return in MSCI down months. During down months, the average MSCI return is minus 3.44. And during those equivalent months, our returns are positive 2.05. Again, just demonstrating that we pay attention to when markets are tough, adjust the portfolio and try and survive it. On the right-hand side, you can see our correlation to other assets. We definitely do not have an investment objective to be uncorrelated to other assets. It is a benefit or a side benefit that comes about because of the way we go about investing. We do end up virtually uncorrelated to everything. Equities, bonds, gold, commodities, and even other hedge fund managers that sit in the equity long short space, which is not entirely where we sit, but it is broadly comparable. So I'm going to hand over to Yianni now, who's going to run through our performance of our individual themes and just provide a little bit of colour on those over the last 12 months. Over to you, Yianni.
Yeah, thanks, Kenny, and hello, everyone. We really appreciate you making the time to join us today. So I'm going to quickly touch on the key contributors and detractors to fund performance over the period. And in the interest of time, I might just touch on the top and bottom contributor over this period, and more than happy to delve into the other themes that you see in front of you in the Q&A portion of the call. So the largest positive contributor to fund performance over the period was our uranium theme. The spot price of uranium has risen materially from this time last year when it was trading at around $30 a pound to end the period at about $47, as the tailwinds supporting the renaissance of nuclear power generation continue to blow favourably for this theme. Despite the material rise in the spot price of uranium, we still have incredibly high conviction in the uranium theme and see significant upside from here. If 4 years ago, when we first began investing in uranium, you had have told us that within a 4-month period, the following events would transpire: the potential for sanctions to be levied on Russian-sourced enriched uranium in retaliation to a war on continental Europe. Due to energy security concerns, the Prime Minister of Japan ordered the restart of at least 9 nuclear reactors by the fall of 2022. The European Union voted for nuclear energy to be part of the taxonomy of sustainable sources of energy, classifying nuclear energy as an environmentally sustainable economic activity, and no new uranium supply had come to market within the year. Our best guess of where the spot price of uranium would be trading would be well north of $60 to $70 a pound. Presently, we're at about $45 a pound, which is still below the marginal cost of production. With demand increasing, supply remaining tight, and the potential for sanctions to be levied on Russian-sourced enriched uranium to tighten the market further, we believe that we're in the early innings of the uranium bull market. So moving on to the largest detractor from fund performance over the period, and that was our long China theme. It was primarily made up of a basket of equities which had exposure to mainland China and various equity indices. Our investment thesis at the beginning of the year for being long China was simple, and it was predicated on the view that liquidity drives markets. China had been tightening financial conditions since the end of 2020, and as we turned the corner into 2022, it appeared as though economic data was bottoming, fiscal and monetary stimulus was coming, and China would act as the perfect balanced long for global investors seeking to move away from tightening financial conditions in developed market economies. However, with the emergence of the COVID outbreak in the middle to end of February, in combination with the country's persistent COVID zero policies, resulted in us exiting the theme, as our initial thesis, in the face of persistent and prolonged lockdowns, which was set to worsen economic data further, was just simply wrong. And whilst it's painful to lose nearly 2% of fund performance in a very short period of time, if we hadn't have acted as fast as we did, the outcome would have been significantly worse. So at this point, I'm going to hand it back over to Kenny to run through the macro risks and opportunities for the portfolio.
Thanks, Yianni. So what drives markets? What do we think drives markets in the long term? Markets, and I should just provide a bit of colour that when we look at things from a macro perspective, we typically look at them from a US perspective. We do look globally. Most of the context we're going to talk about here is primarily with regard to the US markets, the US economy, given that it's such a large part of what drives global market investing. So what drives markets long term? Markets follow the direction of earnings. Earnings are driven by economic activity. Economic activity is produced by money available. Money available is driven by the Fed, and Fed policy is driven by inflation and unemployment. A little simplistic, I know, but it's typically the way it works. So let's, given the current interesting economic situation that we face, take a look at the Fed goals of low unemployment and low inflation. Unemployment is very, very low. And given such low unemployment, this metric is not really going to determine what the Fed does, not in the current situation anyway. So let's turn to the second one of inflation. As we all know, inflation is very, very high, and notwithstanding the recent peel back, the recent numbers, you can see here that over the last 100 years, we've rarely seen inflation at these levels. So what's the Fed doing about that? Well, they're removing liquidity and they're raising rates. In order to fight inflation, the Fed has begun tightening money flows into the economy, and they've done this in two ways. Both of them happen, and this is important to remember, both of them happen only very, very recently. The Fed spiked short-term interest rates from 0 to 2.25 in just 4 months. And they've just begun the process of shrinking their balance sheet. And I mean just, because it only started in June. It's not even at a full level, which will only start in September, at which point they'll be withdrawing $95 billion a month. Now, rising rates work with a lag of at least 3 months, which means the economy is likely slowed from the effects of any fiscal stimulus and inflation due to the pandemic, but it's barely begun to react to higher interest rates. So let's just have a look now in this very, very early stage about what these changes in Fed policy have done to markets. We'll start with valuations. Valuations have contracted significantly from very high levels. We've seen a retracement recently with a market rally. And, you know, valuations, the S&P are at 19 times. So, yeah, well off pandemic highs, but not low by any means. Let's have a look at earnings. What have earnings done? Well, earnings have just begun to peel. Estimates for 22 and 23 have just had 2 consecutive down revision months. That follows, though, 25 consecutive up revision months. So very, very early days. It may be the sign of something. It may be the sign of nothing. So let's go under the hood and have a little bit of a look what's driving that. Revenues is the brown line. Still looks great. Profit margins seem to have turned. So given that profit margins seem to have turned, it seems to us that's the interesting place just to have a look. And what we're looking for here is to see whether there's an emerging trend or not. The reason operating profit margins are important to look at is because they are still well above pre-pandemic levels. So this is potentially where you've got an interesting reversion that could occur. Now, we've taken a bit of a look at some leading indicators just to try and get a sense as to whether that operating margin could revert to pre-pandemic levels or not. Some of this data is pretty early stage, and we're not necessarily suggesting it's conclusive, but we're just trying to give you a sense of what we look at when we're looking for perhaps some of the tail risk outcomes that may not be priced. Small business sentiment has historically had a reasonable correlation with profit margins. Small business sentiment has collapsed and profit margins haven't. So maybe it'll follow it down. The other one that's interesting to watch is labour productivity. Labour productivity also has had reasonable correlation with profit margins. Labour productivity's collapsed. And so this gap is worth watching. To counter that, we do have a consumer that's in good shape. Unemployment is incredibly low, wages are rising, and household wealth is nearly 30% higher than it was prior to the pandemic. Now, these factors will definitely somewhat cushion the fall in economic growth, but by no means arrest the descent. It's also worth just considering core measures of inflation. You know, we've got a lot of forecasts that inflation are going to come down significantly. Whether or not that occurs, you know, we are at 8.5%. So if we come down to 5, which is where around that level where a lot of forecasters have got inflation going to, that is still significantly above the Fed's target of 2. And this is the anomaly that we think is just worth paying attention to. So where does that put us? Well, how policymakers remove accommodations from global economies will remain a crucial theme for us and any other market participant through the rest of 2022 and indeed beyond that into 23 and 24. If inflation remains high, then the Fed has told us they'll keep tightening. If they do, then that will lead to slowing growth, which will lead to earnings being downgraded. risk asset valuations will remain challenged and volatility will remain high. That's effectively what we think is a possibility. What would change our mind on that is if the Fed tells us that they've changed their mind. So we'll be watching the Fed very closely. And of course, the other alternative is that global growth reaccelerates. That would also change our mind. Now, I just want to stress at this point that this doesn't mean we're ultra bearish. What we're suggesting is that we've got a significantly changed regime by the central bank, the Fed, and other central banks around the world, which all tend to operate in lockstep. And the way that they're operating now is very significantly different to the way they have operated. So we think that it's worth paying attention to what they're doing and paying attention to how that's going to affect the underlying economy and how that's going to affect the underlying earnings. And so for that reason, from a top-down perspective, the construction of our book is more or less neutral, and we think it makes sense to stay more or less neutral from net market equity risk until we get a clearer picture on where we're going. I'm just going to hand back over to Yianni now, who's going to talk about some of our themes within the book, because that's, notwithstanding we think it's a challenging macro environment, we've got a really, really interesting set of opportunities and themes within the portfolio. So back to you, Yianni.
Yeah, and just to echo Kenny's comments, whilst we're cautious overall markets and risk assets, we are incredibly bullish on the opportunity set that sits before us on both the long and the short side of the portfolio. Given the rapidly changing macroeconomic landscape, we are for the first time in a very long time finding more short themes than long themes, which is enabling us to keep net market portfolio exposure low without having to rely on outsized index hedge positions to reflect our cautious view on markets. More instructively, our bottom-up assessment also supports our top-down view. The fact that we are finding more shorts from a micro perspective reinforces our portfolio positioning to take a cautious stance on risk assets. So as we move into the back end of 2022 and into 2023, we believe the rapidly changing environment is creating more opportunities for us than we've seen in a very long time. And we're incredibly excited about managing a global absolute return portfolio in this ever-changing dynamic environment. So as we move on to the next slide, these are the current themes in the portfolio. Maybe it's, there we go. And which you can see are a pretty eclectic mix. On the long side, you have carbon credits, connecting the future, energy paradox, special situations, and uranium. And on the short side, you have Australian banks, private asset managers, and a few structural shorts. Whilst we don't have enough time for us to delve into each of these themes in detail, what I do want to highlight is that all of these themes have very different drivers of returns. And this is at the heart of what we look to achieve. We set out to construct a portfolio that is set up to survive in a range of varying market outcomes. So at this point, I might delve into two of the themes presently in the portfolio, both a long and a short theme, to illustrate how we're investing on both sides of the book. So the first theme I'm going to talk to you about is a relatively new theme in the portfolio, and that's our long energy paradox theme. And I'm going to frame the discussion and our thinking around this thesis by a few charts. And no, these are not the charts of various meme stocks, but these are charts of various parts of the energy supply chain, ranging from European baseload power prices, refining spreads, natural gas prices, and thermal coal prices. And the one thing you can see that is in common with all of these price charts is that they have exploded higher in recent times. The universally accepted reason for which is because of the Russian invasion of Ukraine. However, it is our belief that prices were heading higher before this and were always heading higher due to decades of underinvestment in critical energy supply chains that were linked to fossil fuel emissions. This is the thematic that we are seeking to gain exposure to. We are looking to own securities in key parts of the energy supply chain that are beneficiaries of the current ESG investing climate. Investment, both public and private, in legacy fossil fuel industries ranging from baseload power generation, oil refining, shipping, oil and gas have all been on the decline, despite the continued growth in the global economy, which to us represents an increasing demand for energy. It is our belief that prices will remain elevated as the adage of high prices cure high prices does not apply in an ESG conscious investing world. New supply is not coming, which positions legacy energy companies in the perfect position to capitalize on existing infrastructure and go through in the next few years what we believe is going to be a super profit cycle. So if we move on to the next slide, we just want to highlight to you exactly how we are investing within this theme. The oil refining industry is a pristine example. So as coined by Bank of America Merrill Lynch, we're of the belief that we are entering the golden age of refining, with the industry set to undergo a super profit cycle made possible by decades of underinvestment. The setup in the oil refining industry is exactly what we're looking for to invest within the energy paradox theme. You have global supply declining as more oil refineries come offline. And you can see this in the chart at the top right, which is courtesy of ExxonMobil, which has shown material decline in global industry supply of refined product in the past 2 years. And maybe to put this in context from a domestic Australian perspective, we've had a significant amount of oil refineries shut down. In 2011, we had 7 oil refineries. And as of right now, in 2022, we only have 2 operating oil refineries. Secondly, demand is rising. End oil demand is forecast to continue to grow until reaching a peak in 2030, as many emerging markets which have an extreme dependence on fossil fuels continue to go through periods of hypergrowth. And lastly, and probably our favourite part of this theme, is that it is both impractical and implausible to see new supply coming online anytime in the near future. It takes around 7 to 10 years and billions of dollars to develop a new oil refinery. We cannot see who would deploy capital into a project that is going to come online at a point in time that demand for your product has already peaked. This supports our underlying thesis that profits for companies with existing infrastructure is going to be higher and longer as they reap the benefits of a stagnant supply increase. So with oil refining equities trading on single-digit PEs, the market forecasting a return of refining margins back to where they were in 2019 before supply came out of the global market, rising free cash flow yields and increased returns to shareholders, the risk-reward setup is incredibly attractive here. Significant returns to shareholders will cushion the downside, and any sustained upside in refining margins will drive earnings upgrades. The best bit about investing in a theme like this is you're not relying on any multiple expansion or easing monetary conditions, and you're being paid a handsome coupon to power the global economy. So moving on to the short side of the portfolio, an example of a short theme that we have on at the moment has been what we believe an extreme beneficiary of the ultra accommodative monetary conditions that we've seen in the past 2 years, and we are presently short the Australian banks. So during the pandemic, record low interest rates, lowered lending standards, and an drastic increase in household finances drove an explosion in credit growth, which poured into every single Australian's favourite Sunday afternoon topic of conversation, the housing market. Despite positive immigration dynamics and employment levels remaining favourable, we expect the new structurally higher interest rate regime to have a disproportionate impact on the Australian homeowner, resulting in lower credit growth, downward pricing of existing housing stock, and given the large proportion of wealth tied to housing, further downward revisions in economic growth, all driving lower earnings and lower multiples for the Australian banks. So broadly, our short thesis on the Australian banks has 4 key drivers. If we move to the next slide, I'll run through the first of these. We are facing this interest rate rising cycle from record levels of debt to income, which are nearly double that of the United States. And as you can see in the chart in front of you, materially above where the US was prior to the housing crisis of 07 and 08. This elevated level of debt to income means that interest rate rises drive a higher proportional impact on the Australian consumer. Now, look, teasing out the exact data is not easy, but assuming the average mortgage currently held is around $300,000, variable rates rise to 6.4% by year end. This leads to a greater than 6% loss of disposable income for the average Australian household. This impact is magnified when you look at loans that have been made in the past 2 years at an average rate of 2.4%. By the end of the year, you are likely to see a loss of disposable income of around 14% for these households. When you consider the rise in food costs, electricity, and really the rising cost of almost everything that we consume, it's hard to see how there is not a rise of stress in the system, driving increased provisioning from the Australian banks, lowering dividend payout ratios and earnings per share. So as we move to the second leg of our thesis on the next slide, the rise in interest rates will lead to lower lending volumes as a greater proportion of consumers fail to meet serviceability requirements. A 6.4% variable rate needs to be stress tested against an 8.9% interest rate. At these levels, nearly 60% of the average Australian after-tax household disposable income is going into paying their mortgage. We can't see how any bank or lender would feel comfortable providing credit to a consumer that, if you were stressed, would have to spend over 60% repaying their mortgage. And given the record loan growth that we've seen in the past 2 years, it's not unreasonable to see a material decline in lending growth coming into the back end of 2022 and 2023. And as you can see from the chart on the right, banks' share prices follow the level of lending growth in the system. So moving on to the third leg of our thesis, which is on the next slide, it centers around competition. Through COVID-19, banks were given ultra accommodative funding from the government through the Term Funding Facility. What they did over this period was lend at an extremely aggressive fixed interest rates. A lot of these fixed rates are now coming up for maturity, and they're coming up for maturity in a rapidly rising interest rate environment. Consumers are going to be extremely price sensitive as they refinance their mortgages. That level of loyalty that we used to have because we opened a Dolomite account up in the 1990s is going to be gone. We are going to pick the cheapest mortgage we can possibly find. And this sets the stage for an acceleration in mortgage lending competition to accelerate materially from here, ensuring that the structural trend of lower net interest margins persists going forward. And what makes it even more interesting is the environment is already extremely competitive. And don't take it from us. Listen to what the banks have been saying over the past 2 weeks. All of the banks that have reported have all signaled that competition is intense. Well, imagine how intense competition is going to be when people are scrambling to refinance with interest rates, base level interest rates hitting 3% by the end of the year. We think competition is going to be incredibly fierce given this backdrop. Now, moving on to the last leg of our thesis. All of this is coming at a point in time when the Australian banks are trading at a premium to the ASX 200, adding to the asymmetry of the trade. Traditionally, bank valuations have compressed in periods of souring sentiment towards the housing market in Australia. Given the 30% rise in housing prices we've seen in the past 2 years, it is only a matter of time until the front page of the paper begins reporting about the impending housing collapse, driving a souring of sentiment towards the Australian banks. And I know that seems like this is already happening with the ANZ coming out with a forecast yesterday saying that they expect the housing market to drop over 20% in the coming year. The last period of price falls occurred back in 2018, and this drove a 4 PE point contraction of the banks. We don't see why history won't rhyme this time around. And what makes it even better is that banks are trading at a richer premium to the market as participants have focused on the upside from a rising rate environment and seem to be ignoring the pain that comes later on in the process from rising rates. So look, that's it for the pre-prepared remarks on our end. And now we're going to move on to the Q&A section of the call. So you'll see for those of you live on the webinar, there is a raise hand function, and feel free to click on that, and Kenny and myself will unmute you and allow you to ask a question. So whilst everyone's thinking of what questions they're going to ask us, we'll take a pre-prepared question that's come through We've only received one prior to the webinar, and maybe I'll pose it to you, Kenny. Given the uncertainty in the economic landscape, how is the portfolio positioned?
Thanks, Yianni. So the thing I want to stress, I stressed this from the outset earlier in the presentation, is that we don't profess to know where markets are going. We spend a lot of time thinking about the different outcomes that can happen and the probabilities of the different outcome. All we can say is that we are in a new regime. We don't need to guess that. And we're in a regime where central banks and governments are operating differently to the way they did. And we think it's important to respect that. And as a result of that, we don't think that provides an environment for markets to grow earnings massively, for the economies to grow massively, and for multiples to expand massively. So we're keeping our nets tight, but it's been a long time since we've run a balanced long short book without using index to bring the nets back. And we have a number of really, really interesting themes on the long and the short, which is exciting. Yeah, they may not all pay off, but it's I think when we get confirmation of our macro view, which is confirmed by our bottom-up view, that gives us more conviction that that's the right way to run the portfolio. So we'll run it pretty flat with our longs and shorts on.
And it's pretty exciting. We do have a few questions. So look, I'll move it into the order in which people raise their hands and move on to Malcolm. Malcolm, I'm going to allow you to talk and unmute you. So feel free to ask your question. Maybe we'll move on from Malcolm, considering.
Can you hear me now?
Oh, there you are, Malcolm. Yeah, we can hear you.
Oh, sorry, I forgot to unmute.
It's all right.
Firstly, thank you for your presentation. I like your strategy, and I certainly am pleased with the performance so far in our 2 or 3 year relationship. But the one question I wanted to raise was in relation to the geopolitical risks. You didn't make any reference to that, and I note that in Ukraine, there doesn't seem to be any end date involved there. A lot of uncertainty as to how that's going to finish up. You've got the situation in China, Taiwan, where that could be an explosive situation with 2 possible scenarios. One, it's going to be a short-term war, or 2, the US could get involved, which could drag it out. I mean, how do you see these kinds of potential events impacting markets if they, in the short to medium term?
Yeah, thanks, Malcolm. I knew you'd ask a question, and maybe I'll tackle that one. Look, I just want to say from the outset, we don't have any particular expertise in geopolitical events. But we do understand markets and risk, and I'll just take you back to when the Ukraine started. When that Ukraine situation developed and SWIFT sanctions were implemented, we were reminded that Lehman, which is, although they talk about Russia being small in the global economy, Lehman was significantly small in the Russian economy, and it nearly brought the financial system down. So at that point, at the pointy end of the Ukraine invasion, we thought it was sensible to bring risk down. As every day goes on, as every day has gone on, then, and we're a long way from this now, but, as every day went on, the risks of some sort of breakage in the financial plumbing system became less because markets, had the opportunity to break and they didn't. So, those risks diminish. So when it comes to the Ukraine situation, the only comment I make is that it's been going, and this is notwithstanding the awful humane situation, this has been going on for a long time now, and we sort of understand where it's at. Now, obviously that could change any day, but for the moment, I think there is some known unknowns there. If I turn to the Taiwan situation, and again, I want to stress we're no China expert, but one thing that's really interesting about making decisions around China policy is China policy can be made abruptly. That I accept that does happen, but generally China policy is made slowly, implemented slowly, and remains implemented for a very, very long time, often decades. And so it would seem to us that the Taiwan situation is something that's going to be in the background and we're going to have to live with for a long time going forward. There is always the tail risk that something happens right here and right now. We're certainly not planning for that. But one decision that we have made for the moment is we think that China is challenging from an investable point of view. Now, that's not to say we won't run positions there. We just think that it is becoming more challenging because we think that the central regime's objectives don't seem to be aligned so much with the objectives and the wishes of a shareholder of a company. And so as a result of that, and we spoke earlier about, some losses that we'd had investing in China, we have decided to focus less on that area because of those broad risks.
Thank you. Thanks for that, Kenny.
No problem. Thanks, Malcolm. We'll move on to Alex. I'm going to promote you, Alex, and hopefully unmute you.
And you need to unmute your end, Alex, just as a reminder.
Alex, you're if you can. Otherwise, happy to move on to the next in the queue. So maybe I'll change this. And Andrew, I'm going to promote you to allow to talk. And if you can unmute yourself, that'd be great.
Thanks, Yianni. The voluntary carbon credit market's been under pressure for the last 6 months. I just wondering if you're seeing any light at the end of the tunnel regarding it.
So look, maybe I'll step in and take this one. And thanks for the question, Andrew. Really appreciate it. Your photo looks fantastic as well. So look, on the voluntary carbon credit market, it has been a material drawdown to fund performance over this past 6 months. And really what's happened there is it's been a confluence of factors. First, on the Russia-Ukraine crisis, you had a lot of traders exiting positions, existing legacy positions. And it came at a point in time where the end buying demand was just not there. So the typical end buyer of a voluntary carbon credit are corporates, and they typically do their seasonal buying in the back end of the year. And given the uncertainty that unfolded at this point in time, it seemed like people were not willing to step up into the space. And to add to that, the further economic uncertainty that developed over the following 3 to 6 months post that saw the rate of corporate demand slow. So what you'd been seeing in the prior periods were year-on-year growth rates somewhere between 30 to 50% increased demand of voluntary carbon credits, and that moved to 0% growth in demand in Q2 of 2022, which led to an increased response from the supply side, driving down prices. So in terms, do we see light at the end of the tunnel? I think coming into the back end of the year, we do believe it as people are becoming a little bit more comfortable with the current economic environment. We do believe that corporates are going to step in, and all the lead indicators that we have right now are that this is going to essentially more corporates have been opening accounts, which we believe drives increased demand. And you've seen an increase in commitments to reduce carbon pledges. And we think that is the key thing. You're seeing more and more companies come and pledge to meet net zero requirements by 2050 and a significant reduction by 2030. And that was really the core driver in our thesis. And we're still seeing this, albeit people in an economically uncertain environment, the demand and purchasing of carbon credits from corporates has slowed. So we're looking at the back end of the year that we see a material pickup in the market as economic conditions, may be worsening. However, the rapid change in the environment seems to be normalizing post the Russian invasion of Ukraine. Kenny, anything further to add there?
No, I think you've covered it. I mean, it is, I think, encouraging to see that, notwithstanding that we've had a change in global regime, that although there's been a bit of a drop off, we have still broadly seen commitments at a social level and consumer level being pushed upon corporates. So yeah, we've definitely, it's definitely hurt performance as as Yianni pointed out, but we see a couple of catalysts towards the back end of the year, and prices certainly have settled at these levels, and we've been nibbling at these levels, adding to the position.
So hopefully that answers your question, Andrew.
Thank you. Yep, that's great.
Great. Thank you, Andrew. Really appreciate it. So I'll move. So Nicholas, I'll now promote you to ask a question. And then I'll just ask you to unmute. And if you could unmute on your end as well, that'd be great.
There we go. Can you hear me?
Yeah, yep, we can hear you loud and clear.
This is actually Stefan. Question is, can you say a word about those private asset managers on the short side? What sort of idea is that, or theme?
Yeah, again, more than happy to touch on it. So our thesis is, and what we're primarily targeting in the short private asset managers thesis is, we are looking to, and what we do have on currently at the moment is, we are shorts asset managers that have been a significant beneficiary from the increased money pouring into private credit. Our belief is that you've seen a huge tailwind in the past 2 years of ultra low interest rates. People have been chasing yield as treasury bonds offered you effectively zero. So what happened is, we saw a lot of real money accounts position their portfolios to still generate a level of yield. And what was being offered by a lot of large asset managers was direct private credit lending, where some charts, and presentations we've sat in and seen, it was 8 to 9% returns with the same level of volatility as a US Treasury market. So what person wouldn't be attracted into the space? And our belief was that as economic conditions turned slightly more uncertain, you'd see corporate credit spreads blow out, which would lead to capital not going into the space and being slightly more subdued. And this is in contrast to what equity market participants are forecasting of around 30% AUM growth for managers that have these strategies. And that given the level of AUM growth, they are also trading on very lofty valuations. So we see this as a very attractive place to position the portfolio from the short side. Valuations are extreme, especially when you look at, traditional listed equity asset managers are on 8 to 10 times PE. These guys are trading on 20 times. And secondly, you have a real optimistic outlook from equity participants. They're assuming that the trend of the past 2 years, where interest rates were effectively zero, are going to see the same level of AUM growth for these managers. And obviously, in a nasty market environment, which, we're not saying that's our base case at all, but in a nasty market environment, they effectively act like puts for the portfolio, because they are asset managers subject to the economic cycle.
Thank you.
No problem. Kenny, do you have anything to add on that, or?
No, I just touching on that last point. These businesses are great businesses, and when we short names, it's often not the worst companies that we short. And Yianni's last point is crucial to, I think, again, what we think a lot about, and that is, we don't really know which environment is going to happen. We think we know what is probable and what is improbable. But if there's some way we can prepare the portfolio for some tail risks by putting in some positions that will perform really, really well if you get a tail event, then that's something we always strive to do. And these positions definitely sit in that in that box.
So thank you very much for your question, Stefano. Really appreciate it. I'm going to put you back into the queue, and Aman, I'll promote you now, and I'll just unmute you. If you could also do that on your end as well, that'd be great.
Hello, can you guys hear me?
Yeah, we can hear you.
So just a quick note. So I noticed that the carbon credits is a part of your long themes. I'm just curious about how you guys are sort of valuing them, and looking at that sort of valuation pricing as well.
Kenny, do you want to take that one?
Probably touch on unlisted. Yeah, I'll leave it to you, Yianni.
So Aman, we're expressing that through both over-the-counter swaps with with counterparties, Macquarie Bank and Morgan Stanley, as well as futures. So there is a live pricing market that we get both broker dealer and exchange, and that's how we're getting the valuation for them.
And probably I'd just add more broadly, we don't tend to focus on unlisted assets. So although voluntary carbon credit projects, you know, are what you may have been thinking about, we're actually using the standardised product to express our view. We typically shy away from any unlisted assets in the portfolio.
I think that.
Thanks for that. Yeah.
No problem. And I think that covers off everyone except for Alex, who we didn't get onto the line. I think at that point, it's probably a good time to close the call and thank everyone for their time today.
Thanks very much, guys. We really appreciate your time, taking the time to listen and invest with us. And hopefully it's going to be an exciting time ahead. Look forward to working with you.